welcome to the Daily Wrap. We are diving headfirst into a really fascinating situation today. You've got a market that's walking this tightrope between these incredible record-breaking highs on one side and a pretty stark geopolitical reality on the other. So, let's get right into it.
And this quote, wow, it just nails the tension we're seeing. Think about it. Traders were basically popping champagne, celebrating what looked like a soft landing. At the same time, policymakers, they were quietly looking for the emergency exits. That huge gap between sentiment and reality, that's the big story today. And we're going to unpack what it all means.
Okay, so here's what's on deck. We'll kick things off with that big market versus reality conflict. Then, we'll look at how different the economic stories are around the world. We'll peek at the week ahead, get into the nitty-gritty of the currency charts, and then wrap up with a focus on the Indian markets. Let's do this.
So let's talk about this tale of two tapes. You know, just last week it felt like global stocks were unstoppable. They were on an absolute tear. The market was just breathing this huge sigh of relief, thinking, okay, maybe the situation in the Middle East is finally calming down. But as we found out, that optimism didn't last long.
And this slide just lays it all out, right? On one side, you had total Wall Street optimism. I mean, the S&P 500 hitting record highs, the NASDAQ on its longest winning streak since 2013. Incredible stuff. But on the other side, in the policy rooms, you had the IMF sounding the alarm, warning about potential energy and fuel shortages. Then the weekend hit, and bam, a dose of reality. Iran reinstates its blockade of the Strait of Hormuz, strikes resume in Lebanon, and just like that, the risk that was never really gone was right back in our faces.
Okay, so let's zoom out a bit and see how this all looks on a global scale. Because what we're really seeing is this fractured world economy, where all the major players seem to be telling completely different stories.
Right, so take the US for example. The story there is pretty solid. Growth is resilient, inflation is cooling off. It's that classic soft landing everyone's hoping for. Then you look at China. Yeah, they posted 5% growth, which sounds good, but when you dig in, it's all propped up by exports. Their own people aren't buying enough stuff. Domestic demand is just dragging. And the UK? They had this surprise little pop in GDP, but the bond market basically laughed it off, saying, nope, that's not going to last. They're demanding almost 5% yields. That is not a vote of confidence, let me tell you.
And this is where it gets really interesting. The IMF just put out their latest update, and they've actually changed their language. They've shifted from a baseline outlook to a more cautious reference scenario. You know what that is? That's economists speak for, we're not really sure what's going to happen, and we're not comfortable making any big promises. Their message is super clear. Brace for slower growth, higher inflation, and a bunch of other big problems getting worse, from debt piling up to inequality getting wider.
So, what does all this mean for the week ahead? It's actually pretty simple. Geopolitics is in the driver's seat. Full stop. The economic data, it's taking a back seat for now.
Don't get me wrong, we're still going to keep an eye on the important stuff, right? U.S. retail sales, inflation numbers coming out of Europe and Japan, what the central bankers are saying. But really, the market's main focus, it's going to be glued to headlines from the Middle East, especially after that U.S. naval intervention in the Strait of Hormuz. Look, if things cool down, that could be great for stocks. But if the friction continues, that downside risk is very, very real.
All right, time to get tactical. Let's pull up the charts and see what they're telling us. We'll start with the big one, the engine of the whole currency market, the US dollar index, or the DXY.
Man, the DXY chart just perfectly tells the story of this whiplash week. It dropped like a rock to its lowest point since this whole conflict started when Trump announced the Strait of Hormuz was opening up. Risk sentiment soared. But then, Iran came out with these conflicting statements and poof, the dollar reversed right back up. The market's reaction was immediate and loud. And with all this back and forth, our view is still to buy on any dips.
So, let's look at the actual levels here. That 98.60 mark up top, that's the resistance we're watching. It stopped rallies before, so it's a key ceiling. On the downside, you've got your first line of defense at 98.17. But the really big one, the more significant floor, is down there at 97.53. If selling pressure picks up again, that's going to be a major test.
Okay, over to the euro, and surprise, surprise, it basically followed the same script as the dollar, just in reverse. It shot up past that 1.1835 resistance level when the dollar got weak, but then it gave all those gains back when the conflicting Iran news hit. So now, all eyes are on ECB President Lagarde. She's speaking later tonight, so that'll be a big one.
For the euro-dollar, you really want to watch that resistance zone between 1.1780 and that recent peak around 1.1835. Now, the support at 1.1730 is holding up really well,
And honestly, that resilience, that solid structure, is exactly why our strategy here is still to buy on any dips.
Now let's check in on the pound. Friday was just a wild ride for cable. We saw these huge whipsaws back and forth. It tried to test that 1.3600 level, but then that risk-off feeling came back and knocked it right down. Today's a quiet day for UK data. So again, it's all about the geopolitical headlines for sterling.
So, for the pound, the key levels are pretty clear. You've got resistance at 1.3558, and then that recent high around 1.3600 that it just couldn't quite punch through. If we see any pullbacks, the big question will be if that key support down at 1.3450 can hold.
And let's round out the majors with the yen. On Friday, it acted like a textbook safe haven currency. When risk sentiment got better, the pair dropped hard toward 157.49. But as soon as that sentiment soured, it retraced. It's just too choppy right now. For us, this is a no-trade zone at the moment.
Okay, so the levels to know are supports at 158.35 and 157.49. And there's a pretty clear ceiling of resistance between 159.93 and 159.11. But honestly, with how choppy this pair has been, just bouncing around on every headline, we're staying neutral. Caution is absolutely the name of the game here.
All right, let's change gears and focus on the Indian markets. They've really had their own unique story playing out, and we'll start with the rupee.
The rupee has been showing some impressive strength, firming all the way up to around 92.9250. And what's interesting here is that this wasn't just about global sentiment. No, this was mostly a domestic story. You had the RBI, the Reserve Bank of India, stepping in and telling state-run oil companies to cool it with the aggressive dollar buying. It was a really specific and very effective move.
So when we look at the chart for USD INR, you can see that immediate resistance at 93.09 and a stronger ceiling up near 93.40. On the support side, you're looking at 92.77, and then of course that big psychological level at 92.50. That's where you can really see the RBI's influence making a difference.
Now for Indian equities. The Nifty 50 had a great rebound on Friday, jumping over 0.5% to close at 24,353.55. And the really encouraging part? The buying wasn't just in one or two hot sectors, it was broad-based. That tells you there was solid, widespread participation in that rally as those geopolitical worries started to fade a bit.
From a technical standpoint, the Nifty is still a buy on dips play for now. We do have a cluster of resistance levels to get through overhead, starting around 24,597 and going up toward 24,855. On the flip side, if we do see a pullback, the key support zones to watch are 24,276, 24,172, and down to 24,033.
And that really brings us back to where we started. We've seen it across every chart today. Geopolitics is calling the shots. So the huge question I want to leave you with is this. Is the market's stubborn optimism a sign of real strength and resilience? Or is it a major vulnerability just waiting to be exposed? Definitely something to keep in mind as you navigate the markets today.